Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
You've done some studies into what you think might happen with the price of gold and silver. They've been churning in the same spot, it seems, forever. Is there any hope for them in the new year?
Well, long-term gold and silver, I think the story is still intact. We're actively destroying all the fiat currencies of the world. So when priced in dollars or euros or yen, real money like gold and silver will go up over time. And, most people feel like that's not the case because the recent action has been down, but gold and silver went from gold went from $200 and some an ounce in 2000 to $1,900 an ounce in 2011. And since then it's traded off somewhat, but it's still way up from its 2000 price. So the long-term uptrend in gold and also in silver is still intact, and it looks like there's a pretty decent chance that we're beginning the next up leg in this long bull market. I would say it's overdue because we've continued to create mountains of new credit and immense amounts of new currency over the past 5 or 6 years. So now the gap between, for instance, the national debt in the U.S., the government debt, and the price of gold has really widened. They used to track each other. And the amount of debt that we've taken on absolutely requires a huge devaluation of the U.S. dollar and pretty much every other major currency over the next decade. So gold and silver will do really well when priced in fiat currency terms. Now, for the, let's say, 6 months ahead, one of the things that matters to precious metals prices is the action in the paper markets. That's where speculators bet on trends continuing, and the big banks and the fabricators who use the metal for specific things tend to take the opposite side of that bet and try to sucker the speculators in to long futures positions, which they then fleece the speculators out of. And so over the past few months, speculators have gone extremely long, which is usually pretty bullish for gold and silver, because they have to close out their long positions. And then they frequently go very short. So that they've been very long has implied a pullback in gold and silver that sets the stage for another uptrend. And lately that's what's been happening. Gold and silver have gone down a bit, and the speculators have been bailing out of their long positions. So another couple of weeks of this, and the market will be back in balance and ready for another uptrend that'll last, if history's any guide, 6 or so months. So beginning in January and running through June, we might see a pretty nice run in gold and silver, just based on the internals of that market. Now, again, longer term, it's all positive for gold and silver. The Russians and the Chinese continue to buy immense amounts of gold bullion, which they basically just take off the market. They're storing it as a monetary asset, which means they want it to go down so they can buy more, and they don't sell it when it goes up. So that's a very positive thing long term. And the continued destruction of the finances of most of the big countries is extremely positive. So we just need investors to get on board. When individuals start buying gold and silver coins again, then you've got the conditions for a really nice ramp up in price. So we could see kind of a replay of the 2008 to 2011 serious bull market in precious metals sometime in the next few years. And when that happens, a lot of the mining stocks, which have pretty good cost structures now, they've lived with some lean times here, and because of that, they can make money at today's prices, which means if the price of gold and silver go up, they'll make a lot of money. And so they'll become kind of growth stocks for a while, with their prices rising dramatically because their cash flow is rising dramatically. So I think the mining stocks will be an outperforming sector for the next few years, and the junior miners especially will just rocket. Everybody has their example of some little miner they were looking at that went up by 1,000% in 3 months, and stuff like that is starting to happen lately. We had some Western Australia gold miners that may or may not be sitting on a really big deposit and may or may not be able to do the kind of drilling that allows them to delineate how big the project, the resource is and exactly how rich it is. But when these discoveries first started being announced, a lot of these little stocks just took off. There's one called Nova Resources that went from 49 cents US to $6 or $7 US in the space of just a few months. It's since traded back off into the threes, but it's still way up from its low. And if the optimistic estimates of what it's sitting on turn out to be true, then that's a moonshot from here. And if it happens to one, it'll start happening to others. It'll get people excited, and they'll start looking around for what else they can buy that's similar to the one that's going through the roof. And then that really lights a fuse under a sector as small as the junior gold and silver miners. So that's the kind of thing that's out there and should be looked at now. In other words, you should be figuring out which junior gold and silver miners you'd like to buy in anticipation of something like this happening, so that when you feel like it's time, you can jump on them. Or you can buy them now and just assume that that time is coming and ride them through whatever they do in the next few months. I don't know. But I think intermediate term and long-term prospects for gold and silver have gotten really good, much better lately than they had been just a year or two ago.
We'll have more with John Rubino right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with John Rubino. John, the price of cobalt right now, they've started selling it, we're estimating the price in pounds. It used to be in tons, but frankly, when you're talking $60,000, $70,000 a ton, breaking it down into pounds makes sense.
Yeah, well, cobalt is one of those clean tech stories. Think of the raw materials that go into something like solar panels or next generation electric vehicle batteries as the picks and shovels of that gold rush. In other words, it's not the thing itself, but it's the thing that you need to make or run the thing. It's not an electric car, but you need it for the batteries. And frequently, those are the best things to invest in because, you can't know whether Tesla or Volkswagen or GM will end up dominating the electric car market. But there's a fairly reasonable bet that the current configuration of lithium-ion batteries will survive, and the stuff that goes into those batteries will become sought after as millions of new batteries go into hundreds of thousands of new electric vehicles in the next few years. This is apparently an idea that has truly come. You've got governments decreeing that after a certain date there will be no more internal combustion cars made or sold in their countries. and in states, California is looking at something similar. So when, let's say, China and California do something like that, well, that just opens the floodgates. You've got electric cars everywhere. And rightfully so, I think. The technology is much better in a lot of ways than internal combustion engines. If you've driven an electric car, you know that they're way more fun to drive. I drove a Nissan Leaf the other day, which is kind of a low-end electric car, and it's way more fun to drive. It's just a nicer experience. And so I can only imagine what a high-end Tesla or something like that is like to drive. So I think that it's reasonable to assume that 10 years from now, when we go out to buy a car, we won't even be looking at internal combustion. We'll just be looking at the choices in the electric vehicle space. What that means for lithium and cobalt and a lot of the other materials that go into batteries is that they're going to be in demand, and we probably don't have as much as we need. So their prices will tend to go up rather than down in the next few years. Similar stuff is happening in the solar market, where thin film solar, which is something that doesn't use silicon, is getting more and more efficient and finding more and more uses. And so the rare earth elements that go into thin film solar will be in demand as well. So that's the kind of stuff that, if you're thinking of tomorrow's growth stocks or a portfolio that's really environmentally sensitive, you want to look at the solar panels and electric cars, but you also want to look at the components, the things that go into them, and the smaller pieces of gear that make a solar panel. And within those really small sectors right now are some really interesting growth stocks that could have legs for the next 15 or 20 years. So I think, overall, we shouldn't be optimistic about the stock market. I assume, for a lot of different reasons, that we have a financial crisis coming that will take the price of most stocks way down. But I think now is a really good time to get educated about the kinds of things that you want to buy at the bottom of the next cycle. Just accept that the cycle will turn down at some point, because cycles always do, and that this downturn is going to be maybe as brutal as anything we've seen in living memory, which means it's going to create a lot of bargains. It'll terrify people on the way down. It'll, crush the spirits of people who are really long at the point where it starts to turn down. But it's going to be like a candy store for people who have dry powder. If you've got a lot of cash on hand and the market tanks, then that's fun. And so we should be thinking about trying to be one of those people, where we get out of whatever we're into right now at decent prices, and have the cash or the borrowing power or whatever available for some of these things when their prices are cut by 2/3 or 3/4, and nobody wants to touch them because the world is ending. That day is coming when people think that. And they'll probably be wrong, but it's going to seem really realistic at the bottom of the cycle. And there will be things that are just amazing that you can buy, really, let's go back to cobalt. Say a cobalt miner with good finances, a rich deposit that has a lot of years left in it, in a world where electric vehicles are the future. And they're taking over from internal combustion engines. So all the stocks of the world go down. It pulls down the cobalt miner at the same time as everything else. But unfairly, the cobalt miner doesn't deserve to be as low as it is. So that's where you buy it, and then you ride it back up when things stabilize a little bit and everybody realizes, well, yeah, we've got all these internal combustion cars on the road. They're going to have to be junked at some point, and everybody's going to buy electric. So the demand for electric cars will go up just organically. We don't even need new car demand. We don't have to increase the stock of cars out there. We just have to swap out the old cars as they die for new electric cars. And then at that point, you realize that cobalt, if it still goes in electric batteries, will remain valuable, and the miner will go up in price because it's really undervalued versus the cash flow that it should be able to generate. There's going to be dozens of things like that out there at the bottom, or hundreds of things. And, now it's really hard to find attractive stocks out there because they've been bid up year after year after year for such a long time. The opposite will be true. Let's say 3 years from now at the bottom of the next cycle, when it's going to be hard to decide because there are going to be so many interesting potential future growth stocks out there that you can pick up for a song. I have to say I'm looking forward to that. That's way more fun than cyclical peaks when there's nothing to buy. Of course there's a lot to short now. So that's the enjoyable part of cyclical peaks is what do you want to bet against now? Is Tesla a good short? That's the kind of thing that is fun and energizing. Not is Google or Amazon a good buy, after they've been up how many multiples of their 2009 price.
Yes, I've heard it described. It would take you 300 years to get back your investment in Amazon.
Well, from internal cash flow of the company.
Yes.
The really good quality tech stocks and a lot of the less good quality tech stocks are trading at immense multiples of cash flow. So either they need to generate, an awful lot of new cash flow in the future, or it's going to take a really long time to justify that investment. And historically, the way it works is, at this point in the cycle, when you've got these kind of valuations, they turn out to be excessive. And you really wish you hadn't bought them at that price because they go down by half, 2/3, 3/4. You look at the great tech stocks that are around today. A lot of them were around in 2000. Cisco, for instance, or Microsoft. They went down hard. They were great companies the whole time. Intel. These were companies that clearly had great futures. They weren't going anywhere. They were not going to go bankrupt or anything, but still they dropped dramatically. And you could have bought them extremely cheaply in 2000. Something similar happened to the big banks and the home builders in 2008, 2009. They were good companies. They probably weren't going to go bankrupt because the government had their back. So it wasn't so much that they were untouchable as the government had decided they weren't going to let the big banks or the home building industry just cease to exist. So with that kind of backing, their low prices in 2008, 2009, 2010 were really attractive. And the people who were smart enough to see that and bought them made multiples of their investment in the next few years. That day is coming again. And, we won't know until after the fact which category of stocks get cheapest and which turn out to be the best buys, but there will be many. There'll be lots of things to buy at the bottom. And I got to say, I'm looking forward to that day to be able to be optimistic on one of our calls, Jim. Instead of talking about how we're destroying the world and the fiat currencies are doomed and governments are making all these mistakes, to be on this call and saying, you know what, I've got a couple of little growth stocks for you that I think are going to go up by 1,000% in the next 5 years. All right, here's what they do. That's going to be fun to me, compared to being so gloom and doomy like I have been over the past few years.
We'll have more with John Rubino right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with John Rubino. John, so many people now have said, obviously, the stock markets are in a giant bubble. Real estate in places like Vancouver and Toronto, a giant bubble. It's leaking a little bit, but still, the lower classes of real estate are still going up in price. So for the average person, it doesn't appear that the bubble is burst or is deflating. What do you do when you're in a situation like this where people keep warning this can't continue much longer, and yet there's that feeling, well, if I don't stay in, I can't enjoy, the peak of it. Do we spend too much time trying to hit the peak?
Well, yeah. I mean, it's only natural to want that easy money when something's going up day after day after day. And all the people who've been saying it wasn't going to do that have been proven wrong. And the people who said that the stock market was undervalued and it was going to go up, or the housing market, et cetera, whatever asset class you're looking at, the people who were fans of those assets turned out to be right. So who do you trust? The guy who was wrong or the guy who was right? So it's easy to jump on board a train like this. And because, if your time frame is only 5 or 6 years, which is the way it is for most investors, this is all you remember. You just remember stocks going up every year, houses getting more valuable every year, and there's no reason in your experience to expect anything different. And see, that's the point at which it all turns around, because when most people just can't see any alternative to the current trend, that means most people are fully invested. And when most people have basically used all their money to buy this stuff, there are fewer people left to buy it from them. There's no more greater fools out there. Then the system exhausts itself and turns down. It's just the business cycle. There's nothing mystical, magical about it. And by pretty much any measure right now, whether you're looking at real estate or equities or bonds, we are at the end of a really big cycle. Doug Noland, who runs the Credit Bubble Bulletin website, publishes something where he digs into the Fed's Z1 report every quarter. And the Fed basically publishes data on everything, every kind of debt-related thing, every asset price thing that's out there. They toss into this big report. And Noland pulls out the most interesting tidbits. And I took some of his stats and made graphs and charts out of them for a web post here yesterday. And a couple of the stats are just remarkable. For instance, the value of U.S. equities as a percent of GDP hit about 200% in 1999 at the peak of the tech stock bubble. And it hit 180% in 2007 at the peak of the housing bubble. Well, today it's 220%. So, which means stocks are more valuable relative to GDP than they were during the most epic stock market bubble of our lifetimes, which was 1999. So we're in a bigger bubble right now than we were back then. And remember, the year after 1999 and the year after 2007, both of those years were crashes. Equity prices plunged in both cases from those highs. Well, we're above those highs right now. And then if you look at total securities, that is debt and equities, in relation to GDP, it's even more extreme. It was 350% in 1999, 375% in 2007, and now it's almost 450%. So financial asset prices relative to the size of the economy are higher than they've ever been. And the last two times they were even remotely like today's level, that was followed by huge crashes. So if history is any kind of a guide, we've got something like that coming. It might not be next year, might not even be the year after, but we're totally living on borrowed time right now, no pun intended. And at some point, we're going to look back at the numbers as they are today and think, God, that was crazy. How did anybody buy? How did anybody go long on equities with valuations like this? Unless, Jim, this time is truly different. And that's the thing that in every bubble, at the peak of every bubble, worries you, because what if the things that make this bubble, unique, also give it legs, also allow it to keep going when previous bubbles had to burst at these levels of valuation? And in this case, if this is different, it'll be because the world's central banks continue to create huge amounts of new currency, and that currency has to go somewhere. So it flows into U.S. financial assets because we're perceived as a safe haven. That's not unreasonable, but usually the stuff that people point to at peaks of bubbles as allowing that bubble to continue on forever, that's the thing that got you this far, but it's not the thing that takes you to twice the current valuation and so on. It doesn't take you to the moon. It just gets you to the point where you can start looking at it and saying, well, this will get us further, because it just doesn't seem to, and a ton of foreign money has already flowed into the U.S. The amount of U.S. financial assets that are owned by foreigners is up by something like 5 times over the last 20 years, which means that they've already bought a lot of our stuff. And how much more can they buy? Obviously there's some more that they could buy, but it's unlikely that they can keep buying trillions of dollars of U.S. assets year after year after year without deciding that they're overweighted and dumping a bunch of them, which would just send our markets into a tailspin. So that's where we are. We're at the very end in terms of valuation of a bubble using previous bubbles as our yardstick. And if previous bubbles are any kind of an indicator of where we really are, then we're headed for some kind of a serious market dislocation in the not too distant future.
What about companies that are continuing to have massive share buybacks? Home Depot announcing a $15 billion buyback just a few days ago. Lululemon, $200 million. If there's going to be a big drop, why would they go and invest in themselves with that possibility looming over them?
Well, you'd have to ask why they always do it at the peaks of cycles, because that's when it happens.
Yes.
Look at 2007. That's when companies were buying back most of their stock. And 2 years later, they end up issuing equity at half price, so it doesn't work for them at all. And I think one of the explanations is that the circumstances that prevail towards the end of cycles are they leave companies with very few other ways of boosting their share price, because they've done their investing early in the cycle. They've got the factories that they need, and if they have more money, they don't necessarily feel like they can justify more productive capacity. At the same time, central banks have eased to get us out of the previous down cycle, and so money is still pretty freely available, and companies can borrow. But they don't want to borrow to build a new factory because they can't justify it, so they borrow to buy back their stock because that's an instant benefit to shareholders. And corporate executives are shareholders for the most part. So they basically increase their own net worth, and the way it works when you buy back stock is that you increase your earnings per share because there are fewer shares outstanding. So that makes management look smarter because most people don't look beyond earnings per share. So corporate executives get higher year-end bonuses. Their stock holdings go up in value, and for them it's a win-win. But of course they're borrowing money to do that, which means they're leaving their successors with an over-leveraged company. And that's pretty much what's happening in the U.S. especially. Corporate debt in the U.S. is at record levels. In other words, corporations have never been this leveraged, and we're towards the end of the cycle. So if they bought back a ton of stock with borrowed money, what will happen 3 years from now is they'll have to issue stock in order to cover their expenses, but at half price or lower. So they'll look very stupid for having sold stock high and then bought it back low. And in a lot of cases, their existence will be threatened by all the debt that they've taken on, because when sales drop and profitability drops at the bottom of the business cycle, if you can't cover your interest expenses, your company is existentially threatened, and that happens a lot. You see a lot of companies that you'd never expect to go bankrupt at the bottom of cycles because they borrowed too much money in the previous cycle. We'll see the same thing happen again, probably based on the amount of leverage that corporations have taken on next time around. So they won't look as smart then. And share buybacks won't be anything like the perpetual motion machine that they seem like now. It looks like now companies can borrow money for 1% and then buy back their stock and push their stock price up by 5%. It looks like that's a perpetual motion machine, right? You can do that forever because it's a cash flow positive event. But that's only in the upward sloping part of the cycle. On the downward sloping part of the cycle, which always comes, the opposite is true. You're borrowing money probably at a higher rate because rates went up towards the end of the cycle, and you can't buy your stock back, or you can buy your stock back, but nobody thinks that's a good idea because your stock has been falling. So what do? It's not nearly as fun to be running a corporation on the 2-year downslope of the business cycle as it is in the 5-year upslope. And you don't look nearly as smart, you don't have as much fun, nobody treats you the way they did on the upslope when you could, with the stroke of a pen, make your earnings per share go up and get a higher bonus. So that's just the nature of life. We tend to focus on what happened in the near past and extrapolate that out into the indefinite future. That's a really bad way to do things, but that's how the human mind seems to work, so that's how the business cycle works. And I think, Jim, 2 or 3 years from now, you and I will be talking about corporate buybacks, and we'll look back on this and laugh, that IBM paid what for how many millions of shares? Yeah. And, the people that are doing it now, a lot of them will be chastened or out of office. And new people will come in who will vow not to make the same mistakes, but you know what? They'll make mistakes that are similar next time around because it's just human nature. So we as investors need to take that into account and kind of figure out where we are in the cycle. And I think that based on the numbers that we've talked about today, it's a fair bet that we're towards the end of this cycle and heading into the next down cycle.
John, thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Comments or questions for the show, including questions for our guests, can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.